What's up everybody, Gen X Dividend Investor here. In this video I'll show you how my dividend portfolio has performed as compared to the S&P 500 as well as the overall US stock market. I'll also share a warning for people who chase super high yield tickers, and will tell you an interesting discussion I just had with a relative about their retirement. Finally, I'll end things with some thoughts about how dividend stocks will do going forward, so buckle up, it should be fun. Okay, this is a screenshot I took in Fidelity after the market closed on March 11th, 2025, and as you can see my portfolio ended at $3.288 million US dollars. This stuff I've covered up in red are my account numbers and my non-investment accounts. My longtime viewers know that when I started my YouTube channel about 5.5 years ago, I was actually at E-Trade, as I showed you my account over there, and then a little over 4 years ago I switched to Fidelity for a variety of reasons. Before E-Trade I was at Vanguard, and before that I was at T. Rowe Price, and I've had accounts at Schwab and Merrill and a variety of others over the decades. Unfortunately I can't show you my returns from the time I started investing in the 1990s, but feel free to watch an emotional video I made called The Time I Sold All My Stocks for more details on that. And if you're new to my channel, then you can watch my video from last week to see details on all the tickers I hold in my dividend portfolio. Anyway, this screenshot shows you that my cumulative portfolio return since I transferred into Fidelity 4 years ago is 59%, and specifically I'm talking about from February 8th, 2021 until today. If I change the view to be annualized returns instead of cumulative, then Fidelity says that I've been averaging 12.02% per year for the last 4 years. Nice. Part of what has helped me improve my returns over time has been from using fast graphs, which enables me to more easily identify if something is cheap or expensive, and then that influences when I buy and sell. It's one of the few services that I think is worth a subscription, so if you're going to own single stocks, then I wholeheartedly recommend fast graphs. I have an affiliate link and coupon code, which gets new users a discount, but honestly I just want you to get better returns over the long run. Down below you can see that there should be some indexes to compare your returns against, but these are all blank because Fidelity only lists their index returns based on defined intervals of time, like the last 1 month, 3 months, 1 year, etc. But unfortunately they don't show index comparison metrics for specific time ranges, like back to the date I joined. But what we can do is check Seeking Alpha to get total returns of both VTI and VOO for a specific time period, so that we can compare my 59% return to the overall market. Okay, I put February 8th, 2021 as the start date, and March 11th, 2025 as the end date, and we see that the total US stock market return, represented as VTI, and this includes reinvested dividends, has been about 41% over those 4+ years, whereas the S&P 500 has returned about 51%, so it looks like I've outperformed. Now 4 years is a relatively short amount of time, but it's still nice to be outperforming, especially since I've designed my portfolio to be more focused on income than growth. That being said, it's likely that over the long run my portfolio will underperform the market, though if we go into a full-blown recession or a sideways market, then I'll probably continue to outperform on average. These days in retirement, I'm happy to just keep getting income that ideally trends up faster than inflation over the long run, along with a portfolio that hopefully trends up faster than inflation as well, so outperforming the market goes beyond my expectations. What I've seen with my defensive portfolio is that on average it tends to lose less on down days, but it also tends to gain less on up days, so it works for my needs and risk tolerances, but I wouldn't recommend it for anyone else. What I do recommend is that most folks just focus on broad market ETFs like VOO, but I can understand if you want to invest in some single tickers as well. Just make sure that you invest in quality stuff, dividend or not, and try to not quit investing when the markets crash, and if you can avoid that urge, then I'm confident you'll be happy with your long-term results. And speaking of long-term results, another reason I'll probably underperform the market as time goes on is because I'm currently using all my dividends to pay my family's bills rather than reinvest them, whereas the total returns of the market includes the compounding magic of reinvested dividends. Thus, the longer the time frame gets, the less likely I'll outperform. But I'm cool with that because using my divvies has allowed me to retire early, and I can't understate how much I appreciate having the luxury of my time. Okay, and before I move on, I want to quickly talk about something else regarding those empty comparison indexes on Fidelity's returns page. So the first two indexes are more popular, being the S&P 500 as well as the Dow Jones US Total Stock Market Index, which is basically VTI, and then they have an index that most folks probably aren't aware of, which is the MSCI ACWI ex-USA Index, aka the Morgan Stanley Capital International All-Country World Index excluding the United States. It's a broad market index designed to measure equity market performance in both developed and emerging markets globally, excluding US stocks. Or in layman's terms, think of it as something like 85% of all international stocks, and it has companies you'll probably recognize including Taiwan Semiconductor, Tencent, Novo Nordisk, SAP, Alibaba, etc. If you're interested in investing in that index, then you could consider ETFs such as ACWX or CWI. After that international stock index, Fidelity has the Bloomberg US Aggregate Bond Index, also known as the AG, which is a popular benchmark measuring the overall US investment grade bond market. So it includes US Treasury bonds, government agency bonds, mortgage-backed securities aka home loans, high-quality corporate bonds, and asset-backed securities, which are loans backed by assets like cars or credit cards. It's used to help investors compare their own bond investments to the broader market. Finally, Fidelity has the Municipal Bond Index, which is used to measure the performance of investment-grade municipal bonds issued by states, cities, school districts, etc., which typically finance projects like roads, schools, hospitals, and infrastructure. Anyway, Fidelity also has this detailed view of total returns over various time frames, but they don't have the 4-year time frame that I'm at, and I felt that 1 month or 3 months or whatever was too short to discuss. However, I did recently have someone on my free dividend Discord named Dan who was talking about my year-to-date performance, and he guessed that I was at 5 to 7% total, so I figured I'd show you that metric. Now, when I first checked Fidelity, it said that my year-to-date total portfolio return was 7%, but they were talking from January 1 until February 28th, as opposed to March 11th. Apparently, Fidelity only shows you your individual account's year-to-date performance up to the last day, but the total portfolio return they only calculate monthly. So what I can do is switch to the daily metrics, see what each individual account has returned year to date, and then manually calculate what my portfolio's average weighted year-to-date total return would be. So this says my IRA's year-to-date return is 3.49%, my taxable is 6.63%, and the rollover is 8.89%. And with that, I calculated my portfolio's total return is 5.72%, so Dan's 5 to 7% guess was quite good. For reference, the S&P 500 is down about 5% year-to-date, the total US stock market is down about 5.5%, the international stock market is up a nice 6%, the AG is up about 2.3%, and the munis are up about 1%. Let's do a quick check of some of that info against Google to see if the numbers are making sense. And it looks like Google corroborates some of that, as it says that the S&P 500 lost about 5% year-to-date. It also says that the total US stock market is down about 5.4% year-to-date, so it looks like things are adding up. Hopefully all of that now makes sense to you guys, and I actually called up Fidelity to make sure I was understanding their data appropriately. Okay, now I want to shift gears and tell you an investing warning that was just shared on my Discord. So today someone named Kia joined my Discord, and he said, "Hi folks, I'm glad I'm back." I asked him where he had gone to, and he said that the high yield NAV decay of his YieldMax ETF nailed him. He elaborated saying that he lost 38K in the last month due to declining NAV and the market downturn, and he realized that chasing high yield dividends isn't worth the risk. I think it was pretty cool that he was sharing that info because many people don't talk about their losses, and chasing super high yield stuff is often fraught with risk. The truth is that very rarely is anything easy money, whether we're talking about investing or whatever. And you gotta be wary of anything that seems too good to be true. Now you might say, but Gen X, you say dividends are awesome, is that really true? And my answer is that it took active income and decades of compounding until I got big passive income, so yes, it's awesome now, and it does feel too good to be true, but it wasn't easy street to get to this point. 30 plus years of investing and trying to plan for your future isn't always easy. Kia's story actually reminds me of this article I just read titled, "Done with 9 to 5 Grind, Dividend Investor Reaches $5,080 per month, Shares 10 Stocks Fueling His 2026 Retirement Plan." It's about an investor who is making 60 grand a year from his portfolio, but it has an insanely high 31% yield. And an even crazier part is that the dude took out a 6-figure loan to get the cash needed to invest into super high yield tickers. So that's adding risk on top of risk, and I usually see stuff like that from newer investors who are pushing too hard to make money fast. Sure, sometimes that can work out for a small percentage of the population, but normally it doesn't, and when it doesn't, it usually gets real ugly. My advice is to invest with the mindset that it will take many years to get good returns, and don't try to rush the wealth creation. An analogy I love to make is that investing is like working out. You might want to double your bench, or you might want to get that 6-pack, but if you've never been in the gym or if you've got a gut, then you're only going to hurt yourself if you try to force the gains. Instead, you want to start slowly and then keep working at it, learning, and not giving up when you have setbacks. Anything good in life takes time and effort. Don't try to force quick results, or you'll probably end up disappointed. And that leads me to a discussion that I just had with a relative of mine about their retirement. So she's worked hard her entire life and has had great paying jobs, but has always been terrible with money. Like she travels first class instead of coach, has all of her family's meals delivered every day, cashes out her 401k when she leaves her jobs, etc. She's in her 50s now, and like many people, she's totally burnt out by working, and she dreams about retiring and maybe living in Europe. I asked her if she had the cash flow to make her dreams a reality, but she said she hadn't really thought about it. She said maybe she'd sell her house and use that equity, along with could cash out the mine of 401k she had, and maybe that money would get her to retirement age when her Social Security and pension would kick in. So of course I started talking about how she could instead create a dividend income stream to increase her income in retirement, but she said that the stock market was too risky and that even a 10% yield seemed not enough to be worth doing. I explained how compounding and dividend hikes and such could really add up, and that any additional amount of income coming in would be beneficial. So instead of selling her house and living on that money, she could invest it in income-producing equities and then maybe retire earlier to somewhere that had a much lower cost of living, like Thailand or Costa Rica. Then maybe after a few years of being there, her Social Security and pension would come in, and perhaps all of her income would be enough to move to a spendier place like Europe. As she started to see the light towards what was possible, her first comment was that she wished she had saved and invested more when she was younger. And that actually aligns to a podcast I just listened to of a Wharton professor who surveyed a bunch of older adults. Listen to this 30-second clip to see what I mean.
Well, we've done a fair amount of work trying to study what older people do regret. And we were surveying people over the age of 50. And we asked them questions like, we didn't use the word regret because that would have been too leading, but we said things like, looking back, if you had to do it over again, would you have liked to have saved more, about the same, or less? And a majority of the respondents said they wish they had saved more. Only 2% said they wish they had saved less. So definitely regret for not having saved more along the way was very salient.
So my relative is in that same boat, and honestly I'd say that all of us are. I mean, I saved and invested a good amount, and yet I still wish I had invested more when I was younger. So your takeaway is to invest every dime you can afford to invest, because your older self will probably be quite appreciative. That relative I was talking about is unfortunately making the mistake that the majority of the US population is making, which is relying too much on Social Security to cover them through retirement. Unfortunately, Social Security wasn't designed to do that, and a slew of factors will cause it to probably pay out 25% less to all current and future retirees. Plus, you have folks in Congress who want to push back the standard retirement age due to people living longer, and that makes retirement all the harder to achieve. And the reality is that some jobs will tear your body down faster, making an extended retirement age less plausible. Like take a construction worker who's been doing heavy lifting, repetitive movements, crawling through tight areas, and being exposed to harsh weather conditions, all of which can contribute to joint deterioration, chronic pain, and increased injury risk. Those sorts of careers often leave people with arthritis and back injuries, knee problems, etc. That can also be true for firefighters, warehouse workers, plumbers, military personnel, roofers, and tons of other professions. Thus, investing becomes even more critical for those folks, as their career timeframes are often less than the norm. Something to think about. And to end this video, I want to briefly talk about the future of dividends. So I just read this article on Seeking Alpha, which talks about how economists recently cut their forecast for US GDP growth this year. The article said that this presents downside risks to our current forecast of 9% SP 500 EPS growth, but only modest risks to our forecast of 6% dividend growth. The historically limited drawdown in SP 500 dividends is another argument in favor of investing in SP 500 dividends, end quote. It goes on to say that in past recessions, dividends have typically only declined by 1%, compared with an associated 11% drop in earnings per share and a 24% decline in stock prices. It also said that the 2008 financial crisis was an outlier, as dividends plunged 24%, mostly because of a 74% drop in payouts from companies in the financial services industry. But excluding financial stocks, dividends only fell 6%. And side note, me experiencing that large of a dividend cut by financial companies in 2008 was a big reason why my current financial holdings are so light. I feel I should probably get back into JPM again and increase my overall financials holdings, but I've not done it yet. My guess is that there's a reasonable probability that the current administration's regulatory changes may lead financial services companies to pay higher dividends than currently expected. But as the article called out, if we go into a recession or whatever, then management's appetite for large dividend increases may disappear. Anyway, time for me to wind down, so please do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to do a shout out to my newest Patreon aristocrats who recently signed up. So thank yous go out to Spud Goat, Ouch Colonel, who just signed back up, Bartholomew, who signed up for an entire year, giving him a discount, and last but not least to Paul B, who also signed up for a full year. And now I'd like to recognize my channel members, i.e. all the people who clicked that join button on my channel. Thanks everybody, I really appreciate all your support. I'd also like to recommend that everyone check out my FastGraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment even if they sign up for a full year. I'll also recommend you check out my Seeking Alpha affiliate link, as new users often get benefits for signing up. Also check out my Patreon page, as I sometimes have open seats with perks you might like. Whatever you do, don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 84 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.